At roughly 3 a.m. this morning, a single earnings report moved Nasdaq futures by 2%. Not Fed minutes. Not a geopolitical event. One company's quarterly results. Micron Technology printed what analysts are calling blockbuster numbers, and its stock is up 18% before the opening bell. But here's the question serious traders are asking right now. Is this a Micron story? Or is this the market telling you something much larger about where we are in the AI capital expenditure cycle? That answer changes what you do with the next 90 days of your portfolio. Let's be precise about what we actually know from the headlines. Micron reported earnings that the market is characterizing as blockbuster, and the stock responded with an 18% pre-market move. Nasdaq futures followed, surging approximately 2%. Inline inflation data also dropped in the same window, and that combination created a genuine risk-on catalyst. Now here's where we move from reporting to analysis, and I want to be transparent about that distinction. An 18% single-session move in a large-cap semiconductor company is not routine. It reflects a gap between what the market feared and what actually happened. Memory chips, which is Micron's core business, are one of the most cyclical segments in all of technology. They were deeply out of favor as recently as 2023. The fact that Micron is printing results that produce this kind of reaction in 2026 tells you something about the demand environment for the underlying commodity. DRAM and NAND storage. Why does that matter? Beyond the ticker. Because the AI infrastructure build-out is at its physical layer, a memory and compute story. Every large language model, every data center expansion, every inference chip needs memory bandwidth. If Micron is reporting blockbuster numbers, that is a direct data point on how seriously hyperscalers are still spending on that infrastructure layer. This is not a recommendation to buy anything. This is a framework for reading the signal. When a cyclical company with direct exposure to AI spending surprises by this magnitude, it tells you the capital expenditure cycle has not rolled over. That has second-order implications for the broader semiconductor supply chain, equipment makers, substrate suppliers, the entire ecosystem. The actionable insight here is methodological. Stop reading earnings releases in isolation. Micron's result is a data point in a larger network of signals. Your job is to map where it sits in that network before the market fully prices it in. Now let's talk about something the Micron coverage is completely overshadowing this morning, and that is the Darden Restaurants earnings print. The headline reads that Darden beat estimates. Most algorithms and most casual viewers will log that as a positive and move on. But the subheadline is where the actual information lives. Olive Garden growth is weakening. Darden operates a portfolio of restaurant brands, and Olive Garden is its largest and most consumer-representative unit. It is the brand that draws the broadest cross-section of American middle-income diners. When the parent company beats aggregate estimates, but the flagship brand is showing deceleration, you are looking at a bifurcated result. The beat may be coming from higher-end or faster-growing concepts within the portfolio, while the mass market brand softens. Again, I want to be clear. I am doing structural analysis here, not reading the full 10Q. But the pattern this describes is consistent with something we have been watching throughout 2026, a divergence in consumer spending behavior. Higher-income households have remained resilient. Middle-income households are showing signs of fatigue, particularly in discretionary categories like casual dining, where the trade-down effect is visible. Why does this matter for market participants who do not own Darden? Because consumer discretionary is a leading indicator of economic momentum. If Olive Garden traffic is softening, that is a data point about how the median American household is navigating the current cost environment. It is a counterpoint to the bullish semiconductor signal we just discussed. This is not financial advice. It is a framework for holding two apparently contradictory signals in your head simultaneously. Markets are good at that. Individual investors often are not. The Nasdaq can surge on AI infrastructure optimism at the same time the casual dining consumer shows strain. Both things can be true. The question worth sitting with: which signal is more predictive of where we are in the broader economic cycle 6 months from now? Wendy's is also in focus today according to the headlines. We do not have specifics yet on what is driving that attention, but in the context of Darden's mixed consumer signal, watch for whether the narrative is about value menu strategy or unit economics. Those are very different stories. The most important analytical point of this entire morning is not any individual data point. It is the fact that inline inflation data and a major positive earnings surprise landed in the same pre-market window. Let's think carefully about what that combination actually does to market psychology. For most of 2025 and into 2026, the market has been navigating a difficult mental model. Strong corporate earnings are fine, but if inflation reaccelerates, the Fed stays restrictive, and the discount rate on those earnings rises, compressing multiples. That is the bearish scenario that has kept a ceiling on sustained breakouts. What happened this morning disrupts that framework, at least temporarily. Inline inflation data means the disinflationary path has not broken. Micron's blockbuster print means AI-driven capital expenditure demand is still intact. Those two things together give the market permission to re-rate risk assets higher without the offsetting fear of a Fed that needs to act more aggressively. That is why futures moved 2% on what might look, from the outside, like a single earnings report. Now here's the discipline part. And this is where I want you to think like a strategist rather than a trader. A 2% futures gap higher is exciting for approximately 4 hours. What matters is whether the underlying conditions that produce this morning's reaction are durable. Is Micron's demand driven by a genuine multi-year capex cycle, or is this a pull forward of orders? Is inflation staying in line because demand is cooling, which would eventually pressure earnings, or because supply is normalizing, which is structurally healthier? Those are not questions you resolve from a pre-market screen, but they are the questions that determine whether today's jump is the beginning of a new leg higher or a relief rally inside a larger consolidation. This is not financial advice. These are the analytical frameworks worth applying to your own research process as you evaluate what today's move means for positions you already hold or decisions you are considering. The market gave you a clean data point this morning. What you do with it depends entirely on the quality of your framework. This morning gave us 3 signals that point in different directions simultaneously. A semiconductor giant printing numbers that suggest AI infrastructure spending is still accelerating, a consumer bellwether showing cracks in its mass market brand, and inflation data that keeps the Fed's hand where markets need it. The question we did not fully answer: which of those signals is the most predictive leading indicator for the second half of 2026? That is exactly what the next video covers. Subscribe so you do not miss it.